Welcome, Jim Toth. Thank you so much for taking the time to chat. As everybody knows, I'm Thomas Rush with Bootstrap, and I'm lucky enough to be speaking with Jim, Managing Director over at Riverside Acceleration Capital. And we were in touch with you for a number of reasons, but one in particular, and the reason we set up this call was to learn a little bit more about term sheets and the methodology and kind of the mindset that you guys have as investors, because that's essentially the black box that so many companies, founders, and executives don't have insight into when they're applying for capital or when they're in negotiations for capital. So really excited to talk to you guys about it. Yeah, with that, I'll let you kind of introduce yourself, the firm, anything else you'd like, and then we can dive right in.
Yeah, well, thank you so much, Thomas, for having me. I really appreciate it. This is something that I'm passionate about and always love talking about it. So thanks for giving me the opportunity. Thanks for doing what you're doing.
Yeah, of course. So start at the basics. When is the right time to reach out to Riverside in terms of I'm a founder, I'm an executive at a growing company? What should be my trigger in terms of realizing that it's time to touch base with you guys?
Great. Well, first, maybe a little background on Riverside Acceleration Capital, or RAC. We call it RAC for short. So we're a growth-focused investment fund, and we live inside of a private equity firm called the Riverside Company, which has been around for 30 years and has $10 billion of assets that they manage. So what's especially unique about RAC and our approach is that we really are taking almost a private equity type mindset to how we're investing in our companies. We do have two ways that we invest in companies. One, which is what we're focusing on, is the revenue share model. Some people call it royalty model or revenue share investing, a lot of different words for it. We also, when it's the right time for companies, will also invest more traditional equity in our companies. So we're typically investing on the royalty side between $1 million and $5 million. And on the equity side, we're usually doing, kind of 5 million and above. The right time it's really about what the company is looking to achieve. So most of the companies that work with us have gotten to a point where they have, the business is working really well, they're growing nicely, and they are thinking that they may want to raise a growth equity round a little bit down the road. And they want to use our capital as a way to invest in a few initiatives and maybe hit some milestones and leverage the resources we have at Riverside and our ability to be strategic with our companies and get to a point where when they do raise that equity round, they'll be doing that at a much improved valuation at that point.
Yep, that makes sense. So the equity and revenue based, those are separate funds. So is that two transactions, like separate diligence processes, et cetera?
Yes, it's all managed within RAC, but those are separate streams, and obviously very different use cases for those two different types of capital.
Yep, and different return profiles from you guys' perspective, I imagine, things like that.
But it's a very unique ability for us that I really like that about the flexibility that we have, because it allows us to grow with our companies. And that's what we're trying to do. We're making an investment, and we hope that as the company grows, we'll be able to provide them more capital. And so I feel lucky that we have flexibility that can either be more royalty capital or it can be equity capital, depending on what the company needs.
And is there, maybe wrong is too strong of a word, but is there a wrong time to think about reaching out to you guys as a company?
Well, because of where we're situated, we really try to look for situations where companies can take advantage of the network that we have inside of Riverside, and not just the RAC piece, but the whole. So Riverside owns at any given time something like 100 companies, and we're very active with our companies. We have an operating partner who works with them. We're observers on their boards. We're doing a lot with our businesses, and we don't make a lot of investments in a year. So we try to be very concentrated in the companies that we work with so that we can do some of the things that we like to do with them. And so as a consequence, companies, they really need to be at a certain stage in order for it to work. Most of our companies are at least 3 million of annual revenue. And the biggest one right now is something like 25 million of revenue. So
Okay.
I'd say stage is probably the biggest qualifier. And the other qualifiers are, we really want companies that are looking to invest in growth. If a company's looking for liquidity or taking out early investors, we tend not to be a great fit in those kinds of situations. And most of our companies are not profitable. Most of our companies are burning because they're investing in growth. But there is a level of burn at which a company probably should be raising more of an equity round, and that's also a case where the royalty capital might not be a fit.
And I'm curious, you also mentioned that you make a select number of investments a year. Does that affect the terms you're able to offer or affect kind of the deal structure at all or anything else in terms of your relationship with your portfolio companies?
Absolutely. So that's very key to how we work with our companies, and that approach gets reflected in the kinds of terms we offer and the structure of our investment. So for one thing, our investments tend to be very long term. So we structure ours usually over 5 years, which is very unusual. We very often will structure additional tranches of capital that are just so a company knows that it's available as they grow. Because so many of our companies are working with us to facilitate and so that we'll help them raise a bigger growth round, we will often structure a portion of our return that can actually convert into that round, which is something that companies really value. And we also, and the duration is also extremely important. We see some of these are set up as 1 year, 2 year, 3 year kinds of investments. We don't do that, but I've seen that in other flavors of the royalty model, and it can end up creating a little bit of a cash overhang for a company if they don't manage it carefully. The beauty of the recurring revenue software model is that you can invest in customer acquisition and make some of those investments up front and create a nice stream of subscriptions on which to build the business and grow. And so, but it's important that the company is able to really have enough capital and have it for a length of time they can actually make those investments. If there's capital that needs to be paid back in a very short period of time, you're not actually getting the full benefit of it. And that's why I like the fact that we've structured ours over 5 years. We often will try to structure it so that the cash impact to the company is especially low in the first year or two when they're really needing it and investing it, because that's really, in my mind, that's what it's all about.
Yeah, interesting. And is there kind of a grace period up front? I know some investors say no payments for the first 12 months, kind of for the same reasons you're outlining. Is that typically baked into some of the deals you do, or is that not?
Well, it's one of the levers that we can adjust as we're putting our term sheets together. Every one of the investments that we make is structured differently. They're very, again, because it's a kind of a lower model, higher touch approach. They're very tailored to what the company's trying to achieve, and that's certainly one of the levers that we can work with is trying to keep the payments, really as low as possible in those early years, and maybe trading that off against something that's a little bit more back-end loaded.
Mm-hmm.
Or there could be situations where companies aren't sensitive to that, but they want more of a convertible feature, or they're more sensitive to other aspects of the transaction. It just depends a lot on what they're trying to achieve.
That's perfect. You actually started answering several questions all at once that I had. So one is, are there any standard terms that you guys offer to companies, like things that if I know I'm going to be working with Riverside, I know XYZ is kind of the baseline. It sounds like maybe that's not the case because you mentioned that a lot of the deals are tailored. Is that accurate?
That's right. They all will look very different, but what is standard is that they're structured over a long period of time. The sort of active aspects of it. Of we're always at least a board observer on all of our companies. The vast majority of our companies are working very actively with some of our the operating partners that we have, who are executives that are there as a resource. That's always a part of the investments that we make. They always have very little in terms of restrictions. What I like the most about the royalty model is that the alignment is so good. The faster the company grows, the better they're doing and the better we're doing. And that's kind of our incentive, to do as much as we can for our companies and to try to use the resources we have in the most effective way possible. And I think if you then try to put a lot of restrictions and add in aspects that might make it safer from the standpoint of the lender, it's self-defeating, because those same things are going to hinder the ability of the company to invest in their growth.
So cool, long-term active partner, try to have as few restrictions as possible. One other element that you touched on is the levers that you have that you can use when you are negotiating with a portfolio company, when you're structuring these deals. Can you just speak a little bit about those levers that Riverside uses to make a deal that's best for the company and for you guys?
Well, there are a few things. One is just the amount of capital relative to the size of the company. That's one lever that can impact other economics. We can also vary the amount of what's variable versus what is fixed. We've often found that it is helpful if there's some aspect of the monthly payments to us, which, rather than being purely based on a percentage of revenue, is something that's just more fixed, like on a schedule. And that helps both just for the company, for their own planning, and also to make it the payment's not so variable from month to month, especially if you have a company that maybe gets big upfront payments like annual contracts and even multi-year contracts paid up front. So that's another element that we can flex. We can flex the amount of the return that may be convertible into a subsequent round. And that can be very meaningful for a company, especially if they in the near term are thinking about raising a round anyway. They can really appreciate that flexibility, that some of the royalty return can just be converted into the round at that price. The other big aspect is what the company's view of their own capital needs are. Additional availability of capital after the initial investment, that's another lever. So just so that they know that this, there's the initial investment, and they'll, assuming they hit certain milestones, there'd be more capital available to them later on.
That's interesting. I know of other revenue-based investors who do the kind of tiered approach, right? So it's like the first $1 million of revenue is going to be paid back at X%. I haven't heard of the kind of hybrid model where you almost have, like, to oversimplify, a term loan structure where it's consistent flat fee, and then it sounds like layered on top of that is the variable payment. Am I understanding?
Yeah, yes, that's I think, and it's a model that we've found has worked really well.
With all the companies you've worked with, I mean, obviously you have 100 where you said I think you own them outright, or at least you're heavily invested in them on the equity side. You've obviously worked with the number on the revenue-based side. Having gone through all those deal negotiations, kind of what's one thing or several things that you wish founders, executives, et cetera, knew when they came to the table to take capital from you guys?
A couple things. One, usually companies are evaluating us against raising an equity round. That's the most typical. They've got something that's going well, and they're thinking, well, I could go and I could raise an equity round now, but I'd sure rather have hit a couple more milestones before I do that. I often see founders and management teams that don't fully appreciate the cost of equity. And so that's something that we're constantly trying to talk to companies and coach them and just make them realize that their equity is great. It definitely has its place. We invest equity all the time, but it is an expensive form of capital. And so unless the time is is really right. It's best to optimize for lower cost and other forms of capital if they're available. So that's the first thing. And then the second thing, which is also important, is just for people to understand the power of this network that we have in Riverside and the power of the approach, especially on the lending side, somebody that can be strategic and helpful. Like it's one of these things that once we invest in a company, then like they really get it and they love it. And we try to talk about it a lot ahead of time, but it's hard for them really to appreciate how much that's worth unless they've really worked with us. So, the fact that we have, that we're taking this private equity approach, and that's like, you mentioned the 100 companies, that's the power of that network, that Riverside is not just RAC, it's RAC plus a number of other strategies, including a lot of private equity funds that own companies, operate companies, have been doing that for 30 years. And the beauty of the fact that we're part of that organization is that we can take that philosophy and we can apply it to this style of investing. That means a lot of things. We've got operating partners who are working with our companies on developing pricing strategies, or they're bringing a new product to market and they want to think about how to position it. Like, we're in there working with them on initiatives like that. We get our CEOs together and go in depth on topics that are specifically applicable to enterprise software companies at this stage. Like, it's awesome stuff that we're able to do because we're part of this bigger organization.
What a benefit to lean on like the experience from 100 other companies instead of building it from the ground up yourself, which is, the classic way that resources are spent at startups, right? You're building it from scratch for the first time and it takes you a year, where there's an expert out there who's done it 10 times.
Yeah, right. We've spent 30 years developing best practices, and it can be a huge shortcut. One of the things we always try to do is whenever we give a term sheet to a company, we always try to encourage them to, if they can, network directly to one of the other CEOs that we've invested in. And if they don't have any of those connections, then we're happy to do that. But that's something we always encourage our companies to do before they sign a term sheet with us. And anybody who's thinking about working with any provider with this kind of a model, I'd encourage them to also do the same.
Super tactical kind of follow-up question. Do you have a sense for the legal fees that go into it for the company to negotiate through the final execution of the contract with you guys?
Most of the time, it shouldn't be a lot, because the agreements are by design fairly standard, fairly boilerplate.
Yeah.
The key economic terms are in the term sheet. What less than $10,000 for a company for their legal review, for sure.
And this is often for a multi-million-dollar financing, so
right.
Proportionally, this is a very good deal for the companies. You're not just paying lawyers all day.
Yeah, it's one of the nice things. I mean, because my background is actually in equity investing, and that's what I was doing for most of the beginning of my career, where it was only doing the growth side of the growth equity side, Series B, Series C type rounds. They're so expensive, because although the economics are actually fairly similar from transaction to transaction, just the details of how they fit into the cap table are so different, and the legal fees end up being in like the tens of thousands of dollars. It's one of the nice parts about, like, if you have being able to do some of the investing we do on the royalty side, it's very standard. It's just a security agreement, and the economic terms are in the term sheet, so there's a lot less friction.
Cool. And if you can share it, or even give us an idea, what kind of internal rate of return, or what are the economics that you guys are looking for as a firm? Because obviously that's a balance with what the companies can take on as well.
We're really multiple focused in how we structure these investments. So we will usually set it up as a total return of somewhere between maybe 1.6 to 1.8 times our investment, somewhere in that range, with some portion of that often convertible into a future round, so that the cash multiple to us ends up being something lower. That's how we think about it. it's kind of hard to look at it as like a rate of return or an interest rate because it's so variable. So, if you were to look, like, probably on average, it would be, somewhere in the teens, but the way we structure our investments, much lower than that in the early years, so that we're kind of getting to an average of that. But really, we're again, because most companies are comparing us against raising an equity round, we're much more focused on that multiple. So that, that kind of 1.6 to 1.8 compares to equity investors that are usually looking for like 4 to 6 times return on any given investment, at least.
Yeah, I mean, that's a pretty great deal, especially considering it can go down, at least in terms of cost of capital, if they are converting into equity.
In terms of cost of capital, in terms of alignment, if it works for the company at their particular stage, it's something that I personally believe very strongly companies should look very closely at if it's available to them.
Cool. Well, this has been phenomenal. Don't want to take up too much of your time. Really appreciate you walking through all of this for myself as well as for everybody watching this. And speaking of, if there are folks that are watching this, they heard you describe your kind of sweet spot of working with companies, and they're like, "That's me." How should they get in touch?
Either network to us through LinkedIn. I'm sure we're somehow connected, or you can on our website. We're riverside.ac, and there's a very easy form where you can contact us, and we'll get back in touch.
Great. Yeah, that sounds perfect. And obviously, everybody can reach out to Bootstrap. We'll help make sure you're a good fit. That's kind of literally what we're doing nowadays is feeding companies to the appropriate financiers to make sure everybody is using their time the most wisely. So happy to do that as well. And yeah, again, thank you, Jim. Any closing comments or anything you want to say before we wrap up?
No, just thank you so much, and I really appreciate what you're doing. And if anybody out there wants to talk, even if they're not a fit, if they just want advice or thoughts on this market, I'm always happy to connect.
It's awesome. Cool. Well, thank you so much.
All right. Thank you.
All right.